Hello, fellow traders. So what can we expect from the S&P on Friday, June 7th? Will the market go up? Will the market go down? Yes, it will. But seriously, there's an important employment report coming out on Friday, pre-market, and this is going to give us a hint of where the market is going to go. Now, we can draw clues from Wednesday's ADP employment report, and on Wednesday, the previous number was 188,000 jobs added, and the expected number was 175,000 jobs added, and the actual number came in at 152,000 jobs added. So, of course, with fewer jobs added, you would expect the market to go down. But it went up. And of course it went up, because the market is looking for the Fed to lower interest rates. And that's the whole point, and that's what's driving expectations going forward. So, coming down to Friday, tomorrow, June 7th, 8:30 a.m., the U.S. Labor Department employment report. The previous number was 175,000. The forecast is 190,000. This is the number to watch for, 190,000. And the number that fills in over here, the actual number, would tell us where the market is going to go based on where traders feel the Federal Reserve is going to place interest rates. So, as I said, we can infer on Friday based on what happened on Wednesday. Now, on Wednesday, the market report, the employment report, the ADP employment report, came in at far fewer jobs added than were expected. So, let's go to Wednesday's chart. So, here's Wednesday's chart. The market opened right over here, just at the top of the Taylor trading zone, came down, briefly touched just about at the previous close, which of course is equilibrium, and then the employment report, of course, drove the market higher. So based on where the market came to its intraday low, right around here, right at 10 o'clock, the question is, if you know anything about the market and know anything about the videos that I've made based on the Taylor trading calculations, where was the market going to go? Well, if this was the intraday low, the market was going to go to the other end of the Taylor trading range. So let's just clone this, move the clone to the intraday low, right over here, and where did the market end? Right at the forecast range, the top of the range. So that's how we use the Taylor trading zone, and I've made many videos about this. If you've seen my previous videos, you already know this. So what is going to happen on Friday is going to be based on where the market sees interest rates going based on the employment report. Now, there's one other important thing that you need to keep tabs on, and that is on and that is on June 17th, Now there's one other thing that you need to keep track of, and that is the June contract rolling over to the September contract, and that's going to happen on June 17th, okay? So on June 17th, the June contract, the ESM, is going to roll over to the ESU. So the ESU is going to be the new contract, and you can roll over your contract from the M to the U on June 17th. Now, of course, the contract will expire on June 21st, but you can roll it over on June 17th, unless, of course, you trade the continuous contract, the ES1. So that's my video for today. Trade safely, use lots of patience. Thanks so much for watching, and I'll see you in my next video. Marv Eisen for Timeless Dollar Trading Academy.